The market was up big today, and somewhere right now a new investor is opening a brokerage app for the first time thinking they finally understand this. That is the most dangerous moment in retail investing. The S&P 500 gained 1.4%, the Nasdaq gained 1.8%, the VIX fell to 19.8, and space stocks went on a run that made headlines. All of that is true. But the real question is not what happened. It is why it happened, whether any of it means what people think it means, and what a rational investor should actually do with the information. Let's build that picture from the data up. Every meaningful market move has a catalyst story. Today's was producer price data and Fed rate commentary. Two inputs that function like a pressure valve on equity markets. Here's what actually happened and what traders chose to hear, which are not always the same thing. Producer price index data measures inflation at the wholesale level. What businesses pay before those costs reach consumers. When PPI comes in softer than expected, the market reads it as a leading signal that consumer inflation may follow, which gives the Federal Reserve room to hold rates steady or, in a more optimistic scenario, move toward cuts. That chain of logic, softer PPI, lower rate pressure, cheaper cost of capital, higher equity valuations, is not wrong. It is just incomplete. What the market often compresses is the time lag. PPI, feeding into CPI, feeding into a Fed decision, feeding into actual rate changes, is a multi-month process with dozens of variables that can interrupt it. Today's move, priced in an optimistic reading of that chain, in about 6 hours of trading. Institutional desks know this. They are often the ones selling into that optimism. The Fed commentary in the mix today was characteristically non-committal. No forward guidance changed. No vote happened. A headline generated sentiment, and sentiment generated volume. The VIX dropping to 19.8 tells you traders bought options protection down, meaning fear decreased on a single day's read of macro data. For context, a VIX under 20 is not complacency territory historically, but it is meaningfully calmer than the mid-20s readings we saw through stretches of early 2026. The actionable insight here is precise. A single PPI print does not change your portfolio thesis. If your allocation was correct before the data dropped, it is still correct after. What changed is market sentiment, which is a different and far more volatile thing than market fundamentals. The most visually dramatic part of today's session was the sharp rally in space-related equities. When a specific sector moves hard on a green day, it rewards close attention, not because you should chase it, but because it tells you something about how money is moving and why. Space stocks are what analysts call a high beta, high narrative sector. High beta means they amplify broader market moves. When the S&P goes up 1.4%, space names can move 3, 4, 5% in the same session. That is not a sign of particular strength. That is the mathematical consequence of volatility embedded in the asset class. The narrative component means that sentiment around government contracts, launch milestones, or geopolitical developments can trigger outsized moves that have nothing to do with near-term cash flows. What likely happened today is a combination of two forces. First, the broader risk-on environment created by the PPI data lifted speculative and growth-oriented sectors disproportionately, as it typically does. When investors feel less afraid, they reach further out on the risk curve, and space sits at the far end of that curve. Second, sector-specific news or contract developments, the kind that generate headlines but rarely move long-term fundamentals in a single day, may have amplified the move. Here is the statistical reality that most coverage will not mention. Sector rallies of this type, driven by a macro risk-on day rather than fundamental revision, tend to give back a significant portion of gains within 5 to 10 trading sessions. That is not a rule, it is a pattern, and patterns have exceptions. But chasing a 5% single-day move in a speculative sector because the overall market was green is one of the most reliably expensive habits retail investors have. The insight that actually matters. Sector rotation reveals where speculative appetite is flowing, which is useful information for understanding market character. It is not useful as a buy signal in isolation. Understand the difference before you touch the order button. And as always, none of this is financial advice. This is pattern recognition, not a recommendation. If today is one of the first big green days you have watched closely, there's a specific cognitive trap waiting for you, and it has cost more retail investors more money than any bear market in the last 20 years. So let's name it directly. Green days feel like confirmation. When your portfolio is up, your brain generates a signal that says, "This is working. I understand this. I should do more of this." That feeling is not an insight. It is a neurological response to reward that is functionally identical to what happens in a casino. The market does not care about your emotional state, and a single update does not validate your strategy any more than a single red day invalidates it. Here's the data framing that resets this properly. The S&P 500 has historically averaged roughly 253 trading days per year. In a typical year with strong annual returns, you will still experience between 90 and 110 negative trading days, meaning a market that returned 15% in a year was also negative. Roughly 40% of individual trading sessions. The days are not the signal. The trend across years is the signal. What should a long-term investor actually do with today's information? 3 things. First, check whether your allocation is still aligned with your risk tolerance and time horizon. Not because the market moved, but because it is good practice monthly regardless. Second, if you have been sitting on cash waiting for the right moment, understand that market timing has a 30-year track record of underperforming consistent dollar cost averaging for the vast majority of individual investors. Third, resist the urge to add complexity. A diversified, low-cost index position that was correct last week is still correct today. The market moved. The fundamentals of your long-term thesis did not. Those are different events, and knowing the difference is the gap between investing and gambling. Green days are not invitations to act. They are invitations to think clearly while everyone around you is celebrating. We opened today asking what actually drove this rally. Now you have the 3-layer answer. A PPI print that markets read optimistically but incompletely. A space sector amplification that tells you about risk appetite, but not much about fundamentals. And a green day that means far less to your long-term portfolio than it feels like it should. The question this raises for next time, if one PPI print can move markets 1.4% in a day, what happens when the data reverses? That video is coming. Subscribe